Stop scrolling. Right now, silver is trading at $93.50 per ounce. That's up 204% year over year. 204%. But while everyone's celebrating all-time highs, there's a crisis brewing in Mexico that could send silver absolutely parabolic. And nobody's talking about it. Mexico is the world's #1 silver producer. They mine 186 million ounces per year. That's 23% of global supply. But right now, Mexico's silver industry is collapsing. Water wars are shutting down mines in Guanajuato. Endless strikes are halting operations at Fresnillo and Peñoles. New regulations are threatening to ban 60% of production. And here's the part that should terrify every industrial buyer on the planet. With Trump's tariffs, hammering trade relations, and cartels threatening supply chains, Mexico could follow China's playbook and restrict silver exports. China already banned 60 to 70% of refined silver exports on January 1st. If Mexico, the last major silver supplier to the West, locks down their supply, we're looking at a global squeeze that makes the current rally look like a warm-up. This is John A.G., and in the next 12 minutes, I'm going to show you why Mexico's production crisis could ignite the most explosive silver bull market in history. Citigroup is calling for $100 by March. The Oregon Group is projecting $150. But if Mexico pulls the trigger on export restrictions, those forecasts will look conservative. Let's go. Let me show you exactly what's happening on the ground in Mexico right now, because this is not some distant problem that might affect supply in 2 years. This is happening today. This is shutting down mines today. And it's accelerating. First, the water crisis. Guanajuato is the heart of Mexican silver mining. It's where some of the richest deposits in the world are located. But Guanajuato is in the middle of a severe drought. According to a report published by Farmanaut on sustainable mining practices in 2026, mines in the region are already recycling 50 to 60% of their water using closed-loop systems. That sounds impressive until you understand what it actually means. It means there's not enough fresh water to run operations normally. They're reusing the same water over and over because they have no choice. But here's where it gets worse. Mexico just passed sweeping water law reforms. According to Bean Americas, which covers Latin American business and infrastructure, Camamex, the Mexican mining chamber, issued a warning in late 2025 about operational risks from these new regulations. The reforms do 3 things. First, they ban new mining operations in water-scarce areas. That means no new mines in Guanajuato, no expansions, no growth. Second, they mandate 60% water recycling across all operations. Many smaller mines can't afford the technology to hit that target. Third, and this is the killer, they're switching water rights allocation from a permit system to a competitive bidding system. That means mining companies now have to bid against agricultural users, municipalities, and industrial manufacturers for water access. And in a drought, guess who wins that bidding war? Not the foreign-owned mining companies that politicians love to vilify. Now, let's talk about strikes and operational halts. Mexico Business News reported in early January that the mining and metal sector in Mexico is facing cautious optimism for 2026. That's corporate speak for we're in trouble, but trying to stay positive. Fresnillo, one of the largest silver producers in the world, recently ceased parts of operations at their San Julian mine. Peñoles, another major player, just restarted their Tizapá mine after months of labor disputes and strikes. These are not small operations. These are multi-million ounce producers, and they're shutting down or operating at reduced capacity because of labor unrest, regulatory pressure, and resource constraints. And then there's the ore grade problem. According to Fitch's BMI research, as reported by Mining.com, Mexican silver production is forecast to remain flat at approximately 186 million ounces for 2026, despite global demand exploding. Why flat? Because ore grades are declining. The easy high-grade deposits have been mined out. What's left requires more energy, more water, and more capital to extract the same amount of silver. And with water shortages, strikes, and new regulations piling on, Mexican producers can't even maintain current output levels, let alone increase production to meet demand. Here's the context that makes this even more terrifying. 75 to 80% of silver production globally is a byproduct of mining other metals: copper, lead, zinc, gold. That's according to the Silver Institute's analysis of the 2026 market deficit. You can't just decide to produce more silver. You have to mine more copper or lead, which has its own demand cycles and economics. Mexican mines are primarily byproduct operations. So when copper demand is soft, or when operational issues shut down a copper mine, silver production drops automatically. There's no switch to flip, there's no emergency supply, and with Mexico producing 23% of global silver, any disruption there has outsized impact on worldwide availability. Now let's connect Mexico's production crisis to the geopolitical nightmare that's unfolding between Mexico, the United States, and the global silver market. Because this isn't just about mines shutting down. This is about what happens when the world's largest silver producer decides they've had enough of exporting their strategic resources while their own industrial base is starving for supply. On January 1st, 2026, China implemented export licensing requirements for silver. According to investing news coverage of China's new policies, this effectively locked away 60 to 70% of China's refined silver production. China is now prioritizing domestic use for solar panels, electric vehicles, 5G infrastructure, and military applications. They're not selling to the West anymore, not at any price. That removed approximately 100 to 125 million ounces per year from international markets overnight. So where does that leave global buyers? Scrambling to Mexico. Mexico is now the last major silver supplier that Western industrial users and investors can access. But here's the problem. U.S.-Mexico relations are at their worst point in decades. According to a Reuters analysis published on January 14th, Trump's tariffs on Mexican imports are hitting the mining sector hard. Mining equipment, chemicals, fuel, all subject to tariffs that increase operational costs. And Trump has threatened additional tariffs if Mexico doesn't crack down on cartel activity and illegal immigration. The Mexican government is furious. They see these tariffs as economic bullying, and they're looking for leverage. What's the most powerful leverage Mexico has? Silver export restrictions. According to speculation circulating on X, monitored by Mining Stocks HQ, there are growing concerns that Mexico could impose export licensing similar to China's as retaliation for U.S. trade policies. Now, is this confirmed? No. Is the Mexican government officially discussing it? Not publicly. But think about the incentive structure. Mexico produces 186 million ounces of silver per year. Their domestic industrial consumption is maybe 20 to 30 million ounces. That means they're exporting 150 million ounces annually, most of it to the United States, Europe, and Asia. If they cut exports by even 30%, that's 45 million ounces that vanishes from global supply. And with China already out of the market, there's no backup. There's no alternative source. Let me show you why this is even more plausible than it sounds. Mexico has a history of resource nationalism. In the 1930s, they nationalized the oil industry, kicking out foreign companies and creating Pemex. In recent years, President López Obrador's government has pushed policies favoring state control over strategic industries. Mining reform proposals have included higher royalties, restrictions on open-pit mining, and frozen concessions for foreign companies. According to Mining.com's coverage of proposed reforms, some of these measures could threaten 60% of Mexican mine production if fully implemented. The political environment is hostile to foreign mining interests. And if the Trump administration keeps escalating tariffs and trade threats, Mexico has every reason to hit back where it hurts: silver supply. Now add in the cartel factor. Reuters specifically mentioned that cartel strikes are a looming risk to Mexican mining operations. Cartels control large swaths of Mexican territory, including areas where major mines operate. They extort mining companies, disrupt logistics, and occasionally shut down operations entirely to demonstrate power or extract concessions. If U.S. and Mexico tensions escalate, cartels could weaponize mine disruptions as part of broader chaos. And the Mexican government, already stretched thin fighting organized crime, might not prioritize protecting foreign-owned mines. Peru, the world's #2 silver producer, is also facing output declines. According to the same Fitch BMI report, Peruvian silver production is down due to social protests and declining ore grades, so the global supply base is cracking simultaneously. China's out, Peru's down, Mexico's on the edge, and global demand is exploding. Let's talk about what happens to price when supply collapses and demand explodes. The Silver Institute, in their latest market analysis, confirmed that 2026 is on course for the 5th consecutive year of structural deficit. That means global demand exceeds mine supply by 200 to 300 million ounces. For 5 years straight, we've been drawing down above-ground inventories to fill the gap. But inventories don't last forever, and we're approaching the point where there's nothing left to draw down. Industrial demand is the primary driver. Solar panel manufacturing alone consumed 140 million ounces in 2025, up from 100 million in 2023. That's a 40% increase in 2 years. Electric vehicle production consumed 65 million ounces, up from 40 million. Electronics, 5G infrastructure, AI data centers, defense applications, all require silver. And none of these industries can substitute. You can't make a solar panel without silver. You can't build a smartphone without silver. Industrial buyers will pay whatever it takes to secure supply because without silver, their production lines stop. Investment demand is surging as well. As inflation concerns persist and geopolitical risks escalate, investors are piling into silver as a hedge, ETF inflows, coin sales, bar demand all hitting records. Now, let's look at what the banks are forecasting. Citigroup, as reported by Kitco News on January 13th, projects that silver will hit $100 per ounce by March 2026. That's less than 2 months away. Their base case assumes continued industrial demand growth and tight physical supply. But their upside scenario, if supply disruptions worsen or the Federal Reserve cuts rates, sees silver pushing above 110. The Oregon Group, a commodities research firm, published an analysis asking, can silver hit 150 in 2026? Their answer, yes, if the deficit worsens and geopolitical supply shocks materialize. They specifically cite China's export ban and potential Mexico disruptions as catalysts. Here's the contrarian insight. While mainstream forecasts are talking about $100 to $150 silver based on deficits and demand, they're underestimating the speed at which this could unfold. If Mexico announces export restrictions, the market doesn't wait for the restrictions to take effect. The market front-runs the announcement. Price gaps up $20, $30, $50 in a single session as industrial buyers panic buy whatever supply is still available. Physical premiums explode. Dealers sell out. COMEX registered inventories get drained in days. The squeeze that analysts are forecasting for mid-year happens in March. And $150 isn't the top, it's the floor. Now let me give you the reality check and the action plan. Because this is not a guaranteed outcome. This is a high probability scenario based on current trends, but there are variables that could change. The strikes in Mexico could resolve. The water law could be amended. U.S. Mexico trade relations could improve if Trump and the Mexican government negotiate. These are possibilities. But here's what you need to understand. The structural deficit is not going away. Even if Mexico's production stabilizes, even if strikes end tomorrow, we're still short 200 to 300 million ounces per year globally. The water shortages aren't resolving. The ore grade declines aren't reversing. And China isn't opening their export taps again. So the baseline scenario is still bullish. The Mexico export ban scenario is just the accelerant. So what should you do? If you don't own physical silver, buy it now. Don't wait for $100. Don't wait for confirmation that Mexico is restricting exports. By the time that announcement comes, premiums will be 50 to 100% over spot, and dealers will be sold out. Buy American Eagles, Canadian Maples, or 1,000-ounce bars from reputable dealers. Pay the premium. Accept the delivery delay. Secure your position. If you want leveraged exposure, look at silver mining stocks. But be selective. Companies with operations in Mexico, Fresnillo, Peñoles, carry operational risk. Consider diversified producers with assets in multiple countries. If you're trading futures or holding ETFs, understand the counterparty risk. In a severe shortage, ETF creation can be suspended and COMEX could declare force majeure. Here's my prediction. If Mexico announces export restrictions, silver hits 150 within weeks, not months, weeks. If they don't announce restrictions but production continues declining, we still hit 100 by March and 150 by mid-year. The deficit is real. The supply crisis is real. And the Mexico situation is the fuse on a bomb that's already primed to explode. This is John A.G. What do you think? Is Mexico the next domino to fall? Drop your stack size in the comments. Hit subscribe and the bell for daily updates as this unfolds. And remember, by the time everyone sees this crisis, it'll be too late to position. The smart money is moving now. Don't get left behind.